What's up, everybody? I want to let you know that I've tried pretty much every single different strategy when it comes to risk and risk management in this world of Forex trading. I've messed around with only risking 1%, tried seeing what a 20% risk would do. Does it work? Should you try it every once in a while? I've come to the conclusion that you should honestly never lose more than 5% of your account in one session. With that being said, that means you really shouldn't risk more than 4% on a single trade. So how do you end up getting big 20%, 30%, 40% gains from one pattern then? There are a couple of different ways and I'll show you right now. So let's take this move from last night. This is the GBP USD. This is my favorite pair to trade. I call it the Old Faithful for a reason. It's very steady and the patterns form nicely. It doesn't typically move hundreds of pips at a time like some other pairs do, but it's very predictable in its movement. And that makes it very easy to trade. So this move from last night is the perfect one to show you how you can get big gains without risking 10, 20, 30% of your account at one time, which is of course reckless, and I don't recommend that you ever do that. So you see on this move here, we started off with a decent move upward here. It puts in the top, got a little engulfing move down. Got a big spike back up. I believe that was a news event that caused that to happen. But then we get this big giant rejection tail, which usually signals that the move is gonna go downward, which it did. We got a 50% retrace here. Big parabolic move down. We put in the bottom here, and we get a 50% retrace to the upside here. We get a big parabolic move back up. We put in a top here. We got a little consolidation, engulfing move down, a little bit more of a consolidation, and we have a proper entry here. This is a double top after a big parabolic move, so this is a very safe place to sell. I don't think it's worth risking more than 2% here. So if you went with a 2% risk here, you could go either with a 6.5 pip stop loss if you were being more risky, or if you wanted to be a little bit safer, you could go up here above the original top. So that would be 10 pips. How risky or how safe you want to be is up to you. So you could enter your first trade here. And I'll actually show you this on the replay. Let's see. Alright, so you would enter the trade here. So that's where we would risk our first 2%. Big move down, that's a great sign. Big move back up, not such a good sign. Alright, it came back down. A little bit choppy, but we're in a really good place now. Let's see. Okay, this is where we could enter a second trade. It wasn't really a good enough trade to risk 4% at this point, but now that we have two giant rejection tails and pretty much they're all coming down, this is a good place to get into another trade. So you would take a second trade here, 9 pip stop loss, or 10, possibly even like 13.5 if you really wanted to be safe. I would just go with the 9 here, so you could risk another 2% there. So now we have a total of 4% risk on this trade. If it fails, it goes back up here. We would lose 4% of the account. All right, so then the trade continues down. It's a good sign that it came down below this bottom here. All right, now this is a spot where you could add another trade. So you can move both of the original trades. This is our first trade here. You can move that stop to break even. And this is our second trade here. You can move that stop to break even. Now that we have this 50% retrace, trend continuation, big giant rejection tail right at the EMA, this is a good place to enter our third trade. And you would risk 4% here, so you don't have any more risk on these two. The trade fails, these two, you won't lose anything from those. So you're still only risking for the original 4% that you originally risked with the first two trades. All right, trade continues down. So we get a little bit of movement upwards. We're so far away from the 21 EMA that I wouldn't be worried about this. I would still just keep the trades how they are. I wouldn't move anything yet. You could actually even enter a fourth trade here. I wouldn't recommend it, but it would be a safe place to do that. You wouldn't really get much reward from it, most likely. All right, big move down. Got a little bit of momentum upwards. We should be okay here. At this point, you can move all of the stops to right here, above this trend continuation here, to be on the safe side. But generally, a move that comes down this heavy is going to at least put in a double bottom before it goes back up. So you should be safe. Every once in a while, you'll get one that just shoots up, but usually it puts in some type of pattern at the bottom before it continues up. All right. At this point, you can move your stop down, move all three of the stops down to here. Okay. At this point, I would move the stops to here. So the move definitely is starting to lose momentum at this point. We're getting closer to the 21 EMA. All right, so at this point here, I would put the stops right here. And we'll see what happens. We're definitely starting to lose momentum on the move, so we're going to look at getting out of the trades. Yeah, pretty much right there. So all in all, this move took about 8 hours of trade management, so it was a long time. But if you followed these steps to a T, we'll say we had a $10,000 account for this example. You would have made 6 reward on the first trade, so that's 1,200. 4 reward on the second trade, that's 800, and around 3 1/3 reward on the third trade, which is 1,320. So from all 3 trades, you get a total of 3,320, and you only risk $400. That's around a 33% gain for your account in just one day. Now instead, if you were being reckless and you risked 20% of your account for all 3 of your trades, you would have made $26,000. That's even better money, right? Well, not so fast. If you did the exact same thing that we just did, you moved your stops to break even once it was safe to do so, and you ended up getting stopped out of the third trade, you would have instead lost $4,000. So in our example, the maximum amount you could have lost is $400. So it's a big difference. The market really isn't too difficult to trade as long as you have the discipline and the patience to wait for great moves like this. But every once in a while, even on a great setup, you can get stopped out of your trades. So you have to account for this happening, because it does happen, and you don't want to potentially lose 20%, 30%, or 40% of your account in just one day. It's reckless, it's not sustainable, and it's just plain bad trading. You just have to keep in mind, as a trader, you will lose trades, but you have to account for this in your trading plan and make sure that the losses are sustainable. I personally don't go over 5% losses during a session, which I think is a reasonable amount. You can recover from 5% within a day. You can't really recover from 20% in a reasonable amount of time, which is why you should never risk that much in the first place. You just have to respect the process and you will be profitable. All right. So that's all for today. I hope you guys enjoyed the video, learned something new. Make sure you like the video, subscribe for more content. Check out the website at www.ccxcollective.com. and I'll see you guys later.